Hello, and welcome back to the channel. I'm Algabot, and this is the place where we break down automated trading strategies for MetaTrader 5, one clear idea at a time. Today we're examining an expert advisor called triple pivot reversal. It takes one of the most widely taught ideas in all of price action, the classic 1-2-3 swing reversal, and turns it into a fully mechanical, rules-based system. There are no oscillators here and no moving average crossovers, just pure market structure. By the end of this video, you'll understand exactly how it reads swings, how it enters, and how it manages risk. Let's dive in. So what exactly does triple pivot reversal do? At its heart, this expert advisor automates a pattern that discretionary traders have used for decades, the 1-2-3 swing reversal. Picture a market that has been falling. It carves out a low, we'll call that point 1. It then rallies to a high, point 2. Finally, it pulls back, but this time it makes a higher low, point 3, that refuses to break the old bottom. When price finally trades back through point 2, the downswing is considered broken and a fresh upswing is confirmed. The mirror image marks a potential top. That single, elegant structure is the entire engine of this strategy. To find those swings objectively, the EA uses something called symmetric fractal pivots. A pivot high is simply a bar whose high is the strict local extreme compared with a set number of bars on each side, and a pivot low is the same idea in reverse. The number of bars required on each side is controlled by the pivot strength setting, which defaults to 3. The strategy only ever looks at the last 3 alternating pivots, so the pattern is always a genuine low, high, low, or high, low, high sequence. Because it reads raw market structure, this approach is not tied to any single instrument or time frame. It runs on whatever chart and time frame you attach it to, from forex pairs to indices to metals. In terms of style, it's a swing-based reversal and continuation system that aims for fewer but cleaner setups rather than constant activity. It's designed for traders who are curious about structured, rules-driven price action and who want to study how a textbook pattern can be expressed entirely in code. As always, this is educational information only and not financial advice. Let's walk through the mechanics step by step. First, the EA continuously scans for swing pivots using those symmetric fractal points. Each time a new bar closes, it checks whether the bar a fixed distance back has become confirmed as a pivot high or a pivot low, and it keeps a running list of only the most recent alternating swings. Once it has 3 alternating pivots, it tests them for a valid 1-2-3. For a bullish setup, it needs a swing low, then a swing high, then a higher swing low that stays above the first low. For a bearish setup, it needs a swing high, then a swing low, then a lower swing high that stays below the first high. Before it commits to anything, the strategy applies 2 quality gates. The impulse leg from point 1 to point 2 must be at least as large as the minimum leg setting multiplied by the ATR, so it ignores tiny, meaningless wiggles. Then the pullback into point 3 must retrace a healthy fraction of that leg, by default between 30 and 85%. A retrace that's too shallow, or one that almost fully erases the move, is rejected. When a valid pattern is found, the EA arms itself. For a long, it waits for a bar to close above point 2. For a short, it waits for a bar to close below point 2. If, before that happens, price pierces beyond point 3, breaking the higher low or the lower high, the pattern is immediately voided because the structure has failed. Now for risk. The stop loss is placed just beyond point 3 with a small ATR buffer because that's the exact level the pattern says price should not revisit. If that structural stop would be wider than the maximum stop setting allows in ATR terms, the trade is simply skipped. The take profit is set at a multiple of that risk, controlled by the risk-reward parameter, which defaults to 2, meaning the target sits at twice the distance of the stop. Finally, trade management runs on every tick. Once a position moves 1 full unit of risk in your favor, what traders call 1R, the stop is pushed to break even. From there, it trails behind price by the ATR trail multiple times the ATR, protecting open profit continuously while capping adverse moves near scratch. Everything about this design leans toward tight, structurally meaningful risk control. Let's look at the actual MetaTrader code that runs this logic. At the top are the input parameters you can adjust. PivotStrength sets how many bars are required on each side of a swing. Minimum leg ATR and the minimum and maximum retrace values are the quality gates we just discussed. ATR period, SL ATR buffer, risk reward, max stop ATR, and ATR trail multiple all shape the stop, the target, and the trailing. Lots is the order volume. Below that is the breakout block, evaluated once each time a bar closes. If the pattern is armed for a long and the bar's low drops beyond the 0.3 reference, the setup is voided. Otherwise, if the last close pushes above the breakout level, which is 0.2, the EA calls try trigger for a buy. The short side mirrors this exactly. If the high runs beyond 0.3, the setup is canceled, and if the last close drops below 0.2, it calls try trigger for a sell. Inside the trigger, you can see how each order is built. For a long, the entry uses the ask price. The stop is set just below 0.3 by subtracting the buffer times ATR. The risk is the distance between them, and the take profit is the entry plus risk reward times that risk. Then trade.by sends the order. For a short, it's the mirror. The stop sits just above 0.3. The take profit is the entry minus risk reward times risk, and trade.sell places the order. Notice both sides derive the target directly from the structural risk, so the reward is always proportional to how far away the invalidation level is. Let's bring the whole idea to life on this chart, walking through a long trade and then a short trade, candle by candle. On the far left, price is drifting lower. Sellers are in control, and the market steps down bar after bar until it prints a distinct swing low. That low becomes 0.1, the anchor of our potential bullish 1, 2, 3. From that low, buyers step in and a rally begins. Over the next couple of candles, price pushes firmly higher and carves out a clear swing high. That swing high becomes 0.2. Remember, the strategy measures this leg from 0.1 to 0.2 and checks that it's large enough in ATR terms to count as a genuine impulse, not just noise. This one qualifies. Now comes the pullback. Price eases back down, but watch carefully. It stops and turns while still holding above the original low. That higher low is 0.3. The EA measures how far the pullback retraced into the leg and confirms it sits inside the healthy band, between 30 and 85%. We now have a complete, valid bullish structure, a low, a higher high, and a higher low. The strategy arms itself and waits. The next candle is the one that matters. Price closes decisively back above 0.2, the swing high. That confirmed break is the signal, and you can see the buy entry marker appear right there. At that same moment, the stop loss is tucked just below 0.3, the higher low that price is not supposed to revisit, and the take profit target is set at twice that distance, following the default reward to risk of 2. From the entry, price follows through. The next candles climb steadily. The trade moves past 1 unit of risk, and behind the scenes the stop is lifted to break even and then trails upward. Finally, price reaches the take profit target, and the long trade is complete. Notice how the exit lands near a fresh high. Now the chart hands us the mirror image. That fresh high becomes 0.1 of a bearish setup. Price rolls over and sells off into a swing low, 0.2 of the new structure. Then it bounces, but this time the bounce runs out of steam and forms a lower high, 0.3, that stays below the previous peak. Again, the EA checks the leg size and the retrace, and again the structure is valid, this time to the downside. The decisive moment arrives when a candle closes below 0.2, the swing low. There's the sell entry marker. The stop loss is placed just above 0.3, the lower high, and the take profit target sits at twice that risk beneath the entry. Price then works its way lower, candle after candle, moving past 1 unit of risk so the stop can ratchet to break even and trail down. Eventually, price reaches the downside take profit target, and the short trade closes out. Step back and look at the symmetry. Both trades follow the exact same skeleton. 3 alternating pivots, a leg that's big enough to matter, a retrace inside a sensible band, and a confirmed close through 0.2. In both cases, the stop lies at the one level that would prove the pattern wrong, and the target is defined as a simple multiple of that structural risk. That's the whole philosophy. Let the market's own structure decide where you're right and where you're wrong, rather than an arbitrary distance. Of course, not every pattern behaves this cleanly. Real markets produce failed breakouts and voided setups, which is exactly why the invalidation rule and the trailing stop are built in. And that brings us to the end of our breakdown of the triple pivot reversal expert advisor. We covered the classic 1-2-3 swing structure, how the strategy locates pivots with symmetric fractals, the quality gates that filter for cleaner setups, and the structural stop, proportional target, and ATR trailing that manage each trade. Hopefully you now have a clear mental model of how a textbook price action pattern can be expressed entirely in code. Remember, everything in this video is for educational purposes only and is not financial advice. Trading carries real risk, and losses are a normal part of it. If you found this useful, please like the video, leave a comment with the strategy you'd like us to analyze next, and subscribe so you don't miss what's coming. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.